Guys, he had a nice success, learned a lot growing Addus, exiting to Oracle for a reported over 200 million bucks, then took a break at another company and eventually said, you know what? This one man business is the new way to build a company in America. Profitable, 3 million, 4 million bucks in revenue is the way to go. He saw an opportunity, launched collective.com in 2020. They're now getting thousands of applicants every month, very clear pricing at 300 bucks a month or a slight discount, 15% if you pay upfront. He said, quote, they've got thousands of customers today, caught between 1,000 and 10,000. They've grown using outside capital, 7 million seed raised back in 2020, sold around 15 to 20% of the company, then raise a 20 Series A and a $25 million call it note, right? Extension on the A. We'll see what happens next as they look to grow and scale, add new pricing plans, and continue serving these one-man businesses. Hey folks, my guest today is Hooman Radfar. He's a serial entrepreneur and the co-founder and CEO of Collective, the first all-in-one financial platform designed for businesses of one. He previously started Addus, which was acquired by Oracle, was a founding partner at Expa, and is an early investor in Uber, Sweetgreen, Convoy, and more. Hooman, you ready to take us to the top?
Let's go.
All right. So real quick, again, when was that? Oracle acquired Addus, right?
Correct.
What year was that?
The acquisition, I believe, was done in 2015, and I want to say it closed the beginning of 2016.
Okay, so did you go right into Collective after that, or you take a break?
No, actually. So I was at Expo at the time, and I was very lucky. So I didn't have to join the rest of my team at Oracle.
Mm-hmm. Oh, interesting. Now, TechCrunch reported the headline was Oracle buys audience tracking from Addus for around 200 million bucks. So you can really, I assume, do whatever you want. It's good money. It's not FU money. You don't have a private jet, but is that generally accurate?
I'm doing okay. I'm really grateful for it.
That's great. Okay, I guess looking back, there's a lot of founders on right now in a recession. They're all considering selling. Is it just based off what you went through at Addus? Any advice you'd give them on running the process of exiting?
Yeah, I think honestly, I mean, this is a longer discussion, but my TLDR advice is you never really want to sell your company. You want your company to get bought. And I know that's a tough thing to say, but in our case at Addus, Oracle had partnered with us across, I think, 3 different opportunities. And then they'd concluded as a result of those partnerships that it was more cost effective for them to, buy us. And I think that drove a better outcome. When you drive a process to sell your company, typically there's a banker involved and it's almost like a more auction style process. And so when you just look at the math behind that, you don't often get the outcome you want. Now, of course, if you're stuck in that situation, it is what it is. And so I would give a different set of advice. But I guess my advice is don't sell if you can't, if you can wait. That's my advice.
And then I guess second question here, some of these folks that are listening right now, maybe they are doing 5 million in revenue, but they've raised 2 million from VCs, right? And VCs all want a 10x, which would mean they got to sell for at least 20 million. But these founders are getting offers for 10 million, which they'd still like to take. There's obviously a balance you have to do there. You, I believe, went through the same thing. You guys raised 73.2 million at Addus. If you did sell for around 200, you had to do some kind of management with the VCs because not everyone was getting a 10x. How should founders thinking about that today, managing their VCs specifically, think about it?
Yeah, I think ultimately it's a conversation, and most VCs now, in particular, are more founder friendly. They of course, their first customer, they have to make sure that they're returning their fund and their LPs are doing okay. But while VCs do want to get, call it that proverbial 10x, it's a portfolio, right? So every company doesn't need to get that 10x. So if a founder, is emphatic and convinced that the best strategy is to sell, and ultimately the VC is getting a positive outcome, you typically can get that to happen. And more often than not, the VCs tend to be aligned.
Yep. All right. Let's go get back into Collective here. So what is Collective today? Describe your customer. Who's using you?
So you'd mentioned we call them businesses of one. That's a term we coined because when we first started, we called everyone freelancers. And maybe obviously some people don't self-identify as that. As an example, my parents, they were both psychiatrists. They were both businesses of one. I don't think they would consider themselves freelancers, realtors and whatnot. So we want to work with anyone who's really hanging up a shingle on their own, as solo. And that's 36% of the workforce. So it's a fairly large percentage of the population.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time, you can see what it changed over the past 88 days, and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your Founder Path dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of Founder Path, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. How far away from when somebody takes a company public and there's only one full-time employee, the true business of one?
It's actually a really great question. I haven't thought about it, but I know that there are folks that have, when Instagram sold, there was a lot of questions around the exit value per employee, because I believe Instagram was like sub 40 or something like that, and they sold for $1 billion. And so that's become, a number to track, and it's interesting. I don't know. I guess with AI, there's that possibility, to be honest, right? So if
I just think there's a lot of founders that don't realize how big you can get with an army of contractors, and you see this data firsthand. You're sitting on it, so you can look in your database and go, "Wow, these guys." I mean, you're not going to name them, obviously. But you can say, "Wow, these guys are doing 10 million. There's only 2 FTEs. That's amazing."
Yeah. So I will say, I have, especially as an operator, been overwhelmed and impressed by the scrappiness of some of these folks. I think, one of my great passions is being a founder, helping founders. And oftentimes I think there's a cognitive bias in the venture community to assume that venture-backed founders are like the, top 1%, right? Honestly, I think these founders are more impressive in many ways. Like my mom, for example, she ran her business for 30 years. She was profitable the whole time, never raised a dollar. Right now, granted, the scale of it is smaller, but to your point, if you have contractors and you're, just doing FTEs, you can go pretty far. And again, I don't want to jump on the zeitgeist here, but there's a really compelling argument. Like, say, for example, you want to build a content-driven business. If you're using tools like ChatGPT and these other things, you can build a fairly large business with very, very few FTEs. So I do think we're at the cusp of something interesting, to say the least. So it's a great point.
All right, so very good. So just to be clear, like, can you name? Do you have any case studies? Can you name a couple of your actual customers today, so we can really get in their head?
We have some of the customers on the website that we can share. I'll send you some over, but
Well, no, here I just want my audience to really get it. So Doug Binder, who's the founder of WinSprint, David, who's a freelance designer at DHG on Twitter, David Stewart working on a next gen digital health thing, another freelancer and marketer named Michael. These are the kinds of people that are using you.
Exactly. But we have people who, I remember when Delianne Barros, she's like a podcaster on CNN, and she had just been starting. I mean, her business skyrocketed. So I think one of the things that we're seeing, which is new for me, is that because the world has become democratized, and you have tools like look at what we're doing right now. Like, folks can go set up a podcast, folks can go set up TikTok, and the self-serve notion of some of these tools has led to this explosion of these businesses of one that can grow. And people are making like $2-3 million a year, and they go from zero, maybe in a year. And I've seen it several times now. Again, you can look at a venture-backed business and say, wow, this is like the pinnacle. But I mean, if you're one person, you get all that gross profit yourself. I mean, that's pretty amazing. I
No,
mean,
Hooman, it's the
I'll
new
take that.
American dream. It's the new American
Yeah,
dream.
I
$5
think
million
so.
company with 2 million in profits. That's better than a white picket fence, you know?
I know. I agree with that. I agree with that. And I'm really, really excited. I'm learning a ton from our community. So it's been pretty awesome.
Talk to me more about how, let me just, not actually what Doug Binder from Windsprint is paying you, but what is your revenue model? Is it a flat fee? Is it a percentage GMV? Is it something else? How do you monetize?
Yeah, great question. So we don't do percentage of anything like that. It's a flat fee. We want it to be predictable. And we really look at it as, from an ROI driven perspective, ultimately what we're doing is providing a solution, right? By forming your company, providing payroll, doing the books and doing the taxes, that's a solution. And the outcome is we drive tax savings. Now, on average, we're saving $10,000. And for that, we pay a subscription fee, which you will predictably know. You can pay that monthly or annually. And if you pay it monthly, it's like $2.99 a month. So it's a pretty good deal. You get, basically 3 times what you put into it. Plus, it's tax deductible. So how great is that?
What does that mean though? Like when I go on your site and I look at the pricing page and it's $300 a month, it says business formation. But so why would someone keep paying $300 a month after the business is formed?
Oh, great point. Great point. So no, of course, we don't just form the entity. So we'll form the entity. We actually will set up your books for you. We have payroll. So payroll comes with it. Bookkeeping comes. So we do your books every single month. We'll do quarterly tax estimates.
I
We'll
see.
answer any questions that you have, and we'll do your annual taxes. So it's a full service. Again, we deliver that outcome. To deliver those savings, that's all the work you have to do because you need to. I mean, as you probably know, a lot of the magic comes in how you set your payroll when you're trying to get savings in an S corp. So yeah, there's quite a bit of work that goes into it. It's full serve.
So there's really one plan. It's either paying $300 a month or you're paying $254 per month, but paid annually up front. Those are the only two pricing options.
Correct for today, but we have some other options that I think our members have helped inspire us to create that we're going to work on. So both in terms of higher end services that some members are demanding, but also, we have, I would say like 50 times more applicants than we do members, and we're growing very quickly. And part of the reason is because we very much
Wait, sorry,
focused
what do
on
you
these
mean by
S
that,
corps.
Human? I don't know what you mean by that. Applicants
Yeah,
versus members.
so it's a member service, right? So you have to fill out an application. And so we just get tons of applications. Now, one of the reasons that we don't work with people right now is because, look, as a small company, we have a focus point. And our
What's
focus point
small, Human? How many folks are full time today?
at our company,
Yeah.
yeah, we're about 175 employees.
Okay, you're getting up there. I mean, that's a real. You have HR problems. I mean, 175 people is a real business.
Yeah, yeah. Well, I think we're still pretty small, and we need to stay focused. And so we focused on the business of one where you can be helped by an S corp. So if your income is between, say, almost 100K and 1 million, that's our sweet spot. But there's the majority of people are starting out or smaller, and we can package our services for an offering there. So yeah, I'm excited to add more plans on the go forward because ultimately our vision is to help all business of one, but you got to stay focused at the beginning, right? That
Yep.
if you're not, then you're not really delivering for anybody.
Interesting. So are you like you would be filing 1040s for these folks or one of the other ones, corporate or
Yeah,
self-employed?
yeah.
1040s.
So yes, correct.
Okay, interesting. This must be a massive market. Have you tried to map it? How many folks in the US are self-employed that are doing between 100K and a million?
On the 100K to the million side, it's on the magnitude of I'd say 3.5 to 4 million. It's a little difficult because there's some overlap in the data, right? Like when you pull it, there's not like a one data source, but I'd say that's about right.
Interesting. Well, you're on trend because I think when the jobs report came out recently, another stat that came out is like there's a record number of new business applications being formed over the past quarter or half year or something like that. So certainly on trend here. I guess walk me through. So you get tons of applications per month. Where are you getting these applications from? What's sort of the growth strategy?
Yeah, so we're an interesting business because I guess you would call us B2B, right? Because we are a business serving other businesses, but their business is one. So our go-to-market motion is direct to consumer. So channels that you'd be familiar with, right? So Facebook, Google, referral is a massive channel for us. We opened up affiliate. So like we have opportunities now for people to make, 400, 600, $1,000 per new customer that they sign up because
Do you pay that 1,000 to an affiliate all up front?
if they sign up a customer, yeah. So there's different tiers. We're still working the affiliate program. We just launched it. And so I
Okay.
think the initial tier is like you get 400 and then I think it goes up to 1,000 depending on how far you get along the affiliate program, but we're still working on it. But, it's been great. So it looks like that direct to consumer motion because there's just so many folks, right? And they ultimately are individual, but they are businesses. So we have to serve them in that way.
And so can you share order of magnitude how many new applications, not what you're accepting, but new applications you're getting every month?
Right now, let's see. Gosh, I mean, it's thousands right now. I have to go look, but it's
Okay.
definitely it's thousands per month. It's increasing like crazy because, to your point that you mentioned earlier, uh, as you know, we're going through some economic turbulence, right? But when you look at 2008, where I was running my first company, what ended up happening is the freelancer population boomed because what do companies that have W-2s do in periods of uncertainty? They shift to contract labor, and that either increases the income of existing contractors, right, because they're already in business, or creates opportunity for new contractors. That same phenomenon happened in COVID. We saw it firsthand, right? We saw a boom, and now it seems like it's happening again. So, I've been an investor for years. I have got 50 companies in my portfolio. If you're serving other businesses, they're cutting, like SaaS and all of these other things, they're cutting all their forecasts, and we're sitting here, we're growing like crazy, actually. So we're hiring. I think there was just an article in TechCrunch. In fact, we were mentioned in it. I didn't even realize when our employees forwarded it to us that like we're one of the only fintechs that are hiring right now.
Yeah. No, it makes a lot of sense. So thousands new per month. So that means fair to say between 1,000 and 10,000 new applications per month, something on that order.
Yeah, easily.
Okay. And put this on a timeline for me. When did you launch the company? What year?
So we launched officially collective at it was September of 2020.
Is that also when you wrote the first line of code, or was there a bunch of MVP work before that?
A lot of MVP work before that. It's a great insight. So we closed our seed round at the beginning of 2020, right when the COVID started. In fact,
How much was that for?
the first seed round I believe was on the magnitude of 7 million, and we've
And
raised
talk to
50
me why
million
you do
since.
that. Hooman, tell me why you do that. Why people are going to wait? He just sold a company for 200 million bucks. Why wouldn't he bet on himself in his next business? He has all the money in the world. Why not keep as much equity as possible?
I mean, look, it's expensive to start a new business. So, you always need outside capital for these types of businesses. We want to build, a brand that's enduring and iconic like a Square. And at the pace we want to build it at, it just requires a lot of capital. I think if you want to build a business that's sustained off of retained earnings or, the cash flow, that's a different business, right? Then you can, do something more like self-fund, at least at my level. But I mean, even my partner from Expa, Garrett, who'd done Uber, I mean, we typically will raise outside capital. It's just a speed issue.
Yeah.
Second, I would say is the more folks you get around the table, it's not, you get additional perspectives, but also it's, building resiliency in the capital structure, right? So General Catalyst, one of the best investors in the world, top 5 VC, QED, one of the best fintech investors. So as we're growing, I not only gain their perspectives, but they both, of course, have funds. So as there's periods of economic uncertainty, you have more resiliency in the business, right? It's not just one person.
Yep, understood. And I guess most folks, you're also an investor, but most folks in a pre-seed round are selling, 15 to 20% of the company. Were you pretty average there, pretty standard?
Um, at that point, yeah, I think that was about right. Yeah,
Okay.
we were along those lines.
And then I cut you off. I apologize for that. You raised more since then. What was the second round you raised?
So our total that we've raised is around 50 million.
Okay, got it. Well, when was the second? So did you raise more in 2020 or did you wait to do a Series A in 2021? I'm just trying to get the timing of the rounds.
Yeah, so I can walk you through it. So seed round was in closed in 2020, and then in 2021 we had our Series A, and then in 2022 we saw kind of the economic climate going as it was, and we had partners that we're really excited about, and so we just did a quick small note basically to move forward, right? I had been through the first one, and I think one of the mistakes that I made is a lot of founders when they're used to only the growth period, right? And I was in my 20s when I
Hooman,
had to
real
do
quick.
that.
Sorry, before you tell the story, can you quantify? So Series A, how much was the A?
The A was for 20.
Okay. And then what the extension was for another 20 or something like that?
Yeah, it was about 25.
Okay. Sorry. Now tell the story now that people have the numerical context.
Yeah, I guess one of the things, and I'll speak to all of the entrepreneurs out there, when you've only managed through a period of increasing multiples, right? So what ends up happening is you have one thing to think about. People will think about growth, right? And they'll say, oh, okay, if I wait 6 months, 12 months, N months, right, all things being equal, my business should be worth more money. That's actually not true in these types of economies because you may wait 6 months, but if the market is going down, and the multiples are compressing. And for those not to know what multiples are, basically a multiple is a proxy, a way you calculate valuation. So you take whatever the forward revenue is, let's say, for example, 10 million, and you multiply it by 10, you get $100 million valuation. That's an example of how you apply a multiple. Those multiples were going down. And so I'm like, wait a minute, I may create more value in the business. I'm convinced I'm going to do that. But the value of that later on might be less. So all things being equal, you want to err on the side of speed, and you want to raise money at those periods of uncertainty quickly, because there's a lot of unknown later. It's very difficult to kind of like rock as like a first time. Like I have companies, I would tell them that. I told them in March, April, I'm like, dude, this is going crazy. And they waited. And they had brutal rounds at the end of last year.
I was gonna say, so was that 2022 round you did, call it 20-25 million? Was that debt from QED, or was that like a traditional convertible note that you're expecting to convert to equity?
Just a note. It's a YC safe that will convert. Yeah. And it's
interesting.
Yeah. So we had a bunch of outside investors that we were very lucky. Again, same philosophy. Can we bring more value? Can we bring more folks to the table that can help us? So, we had a partner who was an operator-led fund at Innovius. We had the founders of NerdWallet. They came in through Better Tomorrow Ventures. So that was a great one. It was just a lot of people we wanted around the table anyway, quickly coming in while things were still, it was shaky, but it wasn't quite, where it was. And you could see
flat valuation from the Series A, or a little markup.
We were very happy with it.
Okay, fair enough. All right, let's talk about where you see the space going, right? So you've got a big customer base now. You're going to build new products for them. I guess, can you give us context there first before you talk about future products? How many customers, how many of these one-man businesses, one-woman businesses are you serving today?
Thousands.
Okay, so fair to say between 1,000 and 10,000 again?
Yeah. Okay,
can you break 10,000 this year, you think?
There's a lot of ways we can grow faster. It's a lot of this is so let me kind of throw it out there for you. Our problem isn't demand. Our problem, well, I wouldn't even say problem. Our opportunity is, how do we navigate in this environment where raising money, the cost of raising money has changed? Because, as a venture-backed business, we don't operate profitably, right? So I can grow way faster. I could grow 3-4 times faster if I let in more members. The question is, that profitability going to work for us? And the answer is, well, probably not. So we have to work on that. So we actually are limiting our growth purposefully, which is tough in certain ways, but just to focus on being a little bit more profitable, get a little more progress. So that's, again, another thing that changes. It used to be one variable that people are looking at. Hey, what's your top line growth? They looked at the other parts of the system, but with less scrutiny. Now they're looking at the whole
be specific
system.
though. So break down your rule. You're talking about rule of 40, profits versus growth, right? So a lot of people might have said last year, hey, we're okay to grow 100% and have profits be negative 60% EBITDA to get to your rule of 40. You might have a different combination of that in your pro forma rolling forward. Can you break that down for me? Like, what do you hope to grow by top line this year? And what are you happy with on a profitability perspective for the next 12 months?
So we don't like rule of 40 for me. It's not something to look at my stage right now as much. I look more at unit economics. So I look at, gross margin, and I look at top line growth, right? Because for us, we're a subscription business, which is very attractive. We have incredible retention. I would say
incredible, like above 120%.
Well, we don't have any upsell, so you can't do that, right? So
okay.
But we have very, very strong retention. So we're in the top decile for our category. Let's put it that way. And
well, but Hooman, I'm sorry, I have to push you back on that, because I've had ZenBusiness on, I've had Rippling on, and they've got 130, 140, 150% NDR. You're telling me you don't even have the possibility to go above 100 because you have no upsells. So how can you say you're top decile?
We're top decile on the retention for our core product. So if they were to just look at their core product and not the add-ons, there's a retention rate there. I would say that in that zone, I know we're top decile just based on the stats there, but they have add-ons. So you brought up ZenBusiness as an example. They've started to add add-ons. They're a couple of years ahead of us. We'll start doing that as well. So whether it's add-ons or new plans, or you want to upsell plans, like, we just don't have that. We're not focused on it. We're focused on our core product right now, because once we optimize that, then you can add on more things. So we have that potential, obviously, to go above that 100%. And I think you're absolutely right. We would not be in the top, like if we're a public company, for example, you have to be, it's usually like $120 plus is considered top decile on a public SaaS.
I would say 140, 150, 120. Well, I don't know, you'd get a premium for that, but yeah, somewhere in that range. I mean, there's a lot of private companies though that are at that 130, 140, 150 private SaaS companies. To your point though, again, you're focused right now. You haven't upsold anything yet. We'll see what happens there.
We'll let you know. We'll have to come back and like walk through our attached story.
Well, listen, I had Ross on 3 times as he was growing his own business over the past 5 years, and it's crazy how much he changed his pricing. They were selling one-off things to file the thing, and then they tried a
They
recurring
started
plan.
as free, like
They
I
started
think at the beginning.
free.
Yeah.
Yeah, it's all over the place. And then you've got Rippling that feels like they just want to go build everything. And so they get a little dilutive. I mean, I like that you're leading with the persona, the one man. We believe in the one person business. We believe in profitability. I mean, this makes a lot of sense to me. So, hey, listen, we're running short here on time. I do want to try and get a growth number out of you, though. So, like moving forward, what do you hope to grow by top line this year? I mean, are you targeting 50% and you're happy with it, or 200, or what are you looking for?
No, I think on the magnitude of like 2 to 3 times is what we think is pretty good.
Okay.
Because we have to balance again that growth and profitability. We're
So
at
you think
that,
you can
like,
grow 200% and stay profitable?
On the unit basis, absolutely, yeah. So like on a per customer basis is what we do. Yeah. No, we're very profitable on per customer basis. We've been profitable on per customer basis for 2 years, 3 years.
Yeah, that's great. Well, listen, before we wrap up with the famous five, obviously you have one price point. It's basically $300 a month unless people pay annually. You have a couple thousand customers. If it's a 3,000 customers times that ARPU, you're doing about $1 million a month in revenue. Are you able to comment on that?
Benefit of being a private company, no comment. But I hope to be able to comment soon when we go public. But yeah.
All right, fair enough. Let's wrap up here with the famous five. Number one, what's your favorite business book?
My favorite business book. It's probably a little bit boring. So it's a personal productivity book, if that counts. So getting things done.
Okay. Number two, what's your is there a CEO you're following or studying?
CEO I'm following or studying. I follow quite a few CEOs, but I like the Intel kind of family of CEOs, like the Andy Groves and the operators right now, just given the nature of our business is very complex. So I've been like reading a lot about how they work.
And number three,
and Amazon.
What's your favorite online tool for growing collective?
My favorite online tool for growing collective. Wow, that's a good one.
You're just at your computer this morning. What's something? HubSpot. Okay, there you go.
I guess HubSpot, yeah.
Number four, how many hours of sleep do you get every night?
I'm pretty good about my health. So I try to keep it at a minimum 6.5, but I'm averaging 7.3.
All right, there you go. Number four, sorry, last set of questions here. What's your situation? Married, single, kiddos?
Married, happily.
Okay. Any kids?
I'm hoping to ship next year. We're working on
it. Fair. And how old are you, Hooman?
I'm 42.
Last question. Something you wish you knew when you were 20?
It's going to be okay.
Guys, he had a nice success, learned a lot growing Addus, exiting to Oracle for a report over $200 million, then took a break at another company and eventually said, you know what? This one-man business is the new way to build a company in America. Profitable, $3 million, $4 million in revenue is the way to go. He saw an opportunity, launched collective.com in 2020. They're now getting thousands of applicants every month, very clear pricing at $300 a month or a slight discount, 15% if you pay upfront. He said, quote, they've got thousands of customers today, caught between 1,000 and 10,000. They've grown using outside capital, 7 million seed raised back in 2020, sold around 15 to 20% of the company, then raise a 20 Series A and a $25 million call it note, right? Extension on the A. We'll see what happens next as they look to grow and scale, add new pricing plans, and continue serving these one-man businesses. Hooman, thanks for taking us to the top.
Thank you so much. I had fun.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.